Portions of this podcast use AI-generated voices and AI-assisted analysis for commentary and entertainment purposes.
So if you want to know if the global economy is, heading for a recession, you honestly shouldn't even look at Wall Street. You should look under your kitchen sink.
Right, yeah, the consumer products.
Exactly. Welcome to today's deep dive. We are going to open up like a single bottle of shampoo to see how international trade wars and complex global supply chains are really challenging one of the most powerful companies on Earth.
It's a fascinating proxy for the whole economy, honestly.
It really is. So whether you're prepping for a big investment meeting or tracking the consumer goods sector, or honestly, if you're just insanely curious about how these massive global forces impact the stuff you throw in your grocery cart, you're in the exact right place.
Yeah, and our mission today is a really comprehensive breakdown of Procter & Gamble's third quarter fiscal 2026 earnings report.
Right. And to really understand a behemoth like P&G, you have to look past those big, flashy headline numbers.
Oh, absolutely. You have to open the hood, you have to examine the financial machinery underneath, because what this specific earnings report reveals is, well, it's a massive tug of war.
Okay, let's unpack this, because I want to start with that core tension. On one side of the rope, P&G is showing this incredible top-line sales acceleration. Like the consumer's still showing up.
They are.
But on the other side of the rope, you have these incredibly heavy macroeconomic headwinds that are just putting this relentless pressure on their profit margins.
Yeah, and we need to figure out who is actually winning that tug of war. And to do that, we have to start at the very top of the income statement.
Oh, we start with the revenue, right?
Exactly. You absolutely have to start with the revenue engine, because before you can even evaluate profit, you really need to understand the demand for the actual physical product.
And the scale of this engine is just staggering. I mean, we're looking at $21.2 billion in net sales for the quarter.
Which is an increase of 7% versus the prior year.
7%. But I do want to make a really important distinction here for you listening between net sales and organic sales, because the organic sales growth came in at 3%.
Right, and that's a key difference.
It is. The best way to look at this, I think, is to imagine organic sales like checking the engine of a car. Net sales tell you how fast the car is moving. But, that speed might just be because you have a massive tailwind from foreign exchange rates. Or maybe you just bought another car and strapped it to the roof.
That's a really good analogy, yeah.
Organic sales strip away the wind and the acquisitions. It tells you how much horsepower the underlying business is actually producing on its own.
And what's fascinating here is the composition of that horsepower. When we look at that 3% organic growth, we see it was driven by a 2% increase in volume and only a 1% increase in pricing.
Okay, wait, why is that split so critical? I mean, sales are sales, right?
Yeah.
If the number goes up, shouldn't investors just be happy?
Well, not necessarily. See, for the last couple of years, across the entire consumer goods sector, we were seeing companies report really robust sales growth.
Right.
But when you open the hood, volume was actually flat, or in some cases, it was totally negative.
Oh, wow. So they weren't actually selling more stuff.
No, exactly. The only reason their revenue numbers were going up was because they were aggressively raising prices just to offset their own inflation. They were charging consumers more for the exact same box of detergent.
Or they were secretly shrinking the size of the box.
Right.
Shrinkflation.
Right, yeah, the classic shrinkflation.
So it was kind of an illusion of growth. The business wasn't actually expanding its footprint.
Precisely. But here, P&G's growth is being driven fundamentally by volume. That 2% increase means more actual physical units of product are moving off the shelves and into people's homes.
Which is huge.
It is. It signals genuine consumer demand rather than just relying on, inflation masking tricks to pump up the top line.
Okay, and if we want to see where that genuine demand is flexing the hardest, we really have to talk about the beauty segment. This was the absolute standout performer of the quarter.
Oh, absolutely.
Organic sales in beauty were up a highly impressive 7%. We are talking about hair care, organic sales up mid-single digits, and the report specifically credits innovation-based pricing in North America and Europe. Meanwhile, skincare is up high single digits.
Which is a really remarkable data point when you consider the current economic climate.
Yeah, I was just going to say that actually feels entirely counterintuitive to me. People are dealing with high interest rates. They're tightening their belts on discretionary spending. You read about restaurants struggling everywhere.
Right, yeah.
So why are people still buying, like, high-end premium face creams?
Yeah.
How is P&G pulling that off?
It comes down to a strategy called premiumization.
Premiumization, okay.
Yeah, P&G has been highly focused on innovating and marketing premium iterations of their beauty products. And the psychology behind it is actually quite resilient.
Oh.
Well, even when broader economic jitters force consumers to delay big purchases, say like a new car or a lavish vacation, they still want to experience luxury in their day-to-day lives.
Oh, so they treat themselves to the premium skin cream instead.
Exactly. It feels like an affordable indulgence. And P&G has positioned their portfolio to perfectly capture that exact psychological dynamic, successfully pulling consumers upmarket despite all the macro pressures.
Okay, so we've established that the consumer's still buying, and they're even willing to buy premium products. But here is the paradox of this whole earnings report. Selling more product didn't actually mean they made a wider profit.
No, it didn't.
Let's look at why their earnings per share tells a completely different story than their sales. Because when we move from top-line revenue down to bottom-line profit, the headline numbers get a little, well, confusing.
This is where reading the footnotes of an earnings report becomes absolutely vital for any serious analyst.
All right, so I'm looking at these two numbers, and they're just telling me two totally different stories. The diluted net EPS earnings per share was reported at $1.63. That's a solid 6% increase from the prior year.
Right.
But right next to it, they report core EPS, and the core EPS was only $1.59, which is just a 3% increase. The math doesn't work unless there's a ghost in the machine somewhere.
Yeah, there is a ghost.
What happened here? And actually, before you answer, let's also define diluted for everyone listening so we aren't just throwing financial jargon around.
Good point, yeah. So diluted EPS is basically a worst-case scenario accounting metric. It calculates a company's profit per share while assuming that every single stock option, convertible bond, or warrant out there magically gets cashed in and converted into common stock.
So it dilutes the profit pool by expanding the number of total shares.
Exactly. So that diluted EPS grew by 6%, but the reason it outpaced the core EPS growth of 3% comes down to a really specific one-time event, the dissolution of the Glad joint venture.
Wait, the Glad trash bag business. P&G was in a joint venture with Clorox. Why would two massive consumer giants who actively compete in the cleaning aisle team up on trash bags in the first place?
Well, joint ventures are often strategic alliances formed to share the immense risk and capital required to dominate a specific product category or even a geographic market.
Right, makes sense.
Years ago, it just made sense for them to pool their resources. But businesses evolve and strategic priorities shift over time. So back in January of 2026, the Glad joint venture agreement expired.
Okay.
And Clorox purchased P&G's minority stake in the venture at fair market value, which was a $476 million transaction.
Wow. So P&G just gets this sudden massive injection of cash.
Yes. For P&G, that transaction resulted in a one-time after-tax gain of $261 million for this specific quarter.
Ah, okay.
Yep.
So if we connect this to the bigger picture, I assume that's exactly why analysts focus on the core EPS instead of getting distracted by that sudden windfall.
That is the exact mechanism at play, yeah. I mean, think of it like this. If I sell my house this year, my total income looks incredible on paper.
Right, you look rich.
Right. But it doesn't mean I suddenly got a massive recurring promotion at my day job. I can't sell that same house again next year.
You only have one house to sell.
Exactly. Analysts, and honestly P&G's own management, use core EPS because it deliberately strips out these one-off anomalies, like selling a stake in a trash bag company, to show you the sustainable recurring run rate of the actual underlying business.
The day-to-day operation of, manufacturing and selling soap, shampoo, and detergent.
Exactly.
And that core sustainable business grew its earnings by 3%, which brings us right back to our central tension, because here's where it gets really interesting. The sales grew by 7%, but the core EPS only grew by 3%.
Right.
If sales are growing twice as fast as the actual core earnings, something is actively bleeding the profits. Let's look at the specific culprits dragging these margins down, because P&G lays it out very clearly in the report, though they do use some pretty dense accounting terms to do it.
Yeah, they do. And the margin squeeze is really the true story of this quarter. It's the big yes, but of the report. Yes, top-line sales are great, but the cost of doing business is rising dramatically.
Right. So they report that core gross margin was down by 100 basis points. Wait, before we go further, you keep saying basis points in these reports.
Yeah.
Just to ground everyone, 100 basis points is exactly 1%, right? So 100 basis point drop is a 1.0% hit to their margins.
That is correct, yes. It's just it's a more precise way for the financial sector to discuss really small percentage changes without getting bogged down in decimals all day.
Got it. Okay, so they took a 1% hit to their core margins,
Yeah.
and they list the headwinds. So we have 180 basis points of negative impact from unfavorable mix, 100 basis points from reinvestments, 50 basis points from higher tariff costs, and then 10 basis points from unfavorable commodity costs. Let's tackle unfavorable mix first because, honestly, it sounds like corporate speak for a really bad product launch.
It does sound opaque, I'll give you that. But the mechanics of unfavorable mix are so critical to understand here. In this context, it basically means that even though P&G sold more total products, the physical composition of what they sold shifted in a way that hurt their overall profitability.
Wait, but if I'm a shareholder, I don't really care if you sell a premium cream or a basic bar of soap as long as overall sales are going up, right? Why does the mix hurt the bottom line so drastically?
Well, you have to think about the profit margin baked into different items. Let's say you sell high-end electric toothbrushes, which might have a 50% profit margin.
Okay.
And then you also sell basic travel-size toothpaste, which only has a 10% profit margin.
Right, much lower.
Now, if a recession hits and consumers suddenly stop buying the expensive toothbrushes, but they start buying double the amount of cheap toothpaste, your total volume of units sold goes completely through the roof.
Oh, I see.
But because you're selling mostly the low-margin items, your overall profitability percentage just takes a nosedive.
That makes a lot of sense. You're moving more boxes, but you're making pennies on the dollar compared to what you used to make.
Exactly. And mix isn't just about the product itself. It can also be geographic.
How does that work?
Well, if P&G sees much faster volume growth in emerging markets where the distribution logistics are incredibly expensive, the profit margin on every unit sold in that region is naturally lower than a unit sold in, say, North America. So total global sales go up, but the blended profitability gets heavily diluted.
And to put this in perspective, when you combine that unfavorable product and geographic mix with the very real external pressures of higher global tariffs and the rising cost of raw commodities, you can really see why those margins are feeling the squeeze.
They're essentially dragging a massive anchor behind them while trying to sprint.
They really are. But there is a silver lining here that we absolutely have to highlight. Because while they faced all those huge headwinds, P&G also managed to generate gross productivity savings of 210 basis points. That's a 2.1% margin recovery just from internal efficiencies alone.
And that operational efficiency is perhaps the single most important defense mechanism this company possesses.
Yeah.
P&G is famous for its internal productivity engine. I mean, that 210 basis points of savings doesn't just happen by accident.
Right.
It's the result of ruthlessly finding ways to manufacture faster, redesigning packaging to fit more units on a single shipping pallet, optimizing supply routes to burn less fuel, and, just reducing raw material waste on the factory floor.
So basically, if they didn't have that internal machinery constantly grinding out pennies of savings across billions of units, those macroeconomic headwinds would have completely devastated their bottom line.
Oh, without a doubt. That productivity engine is basically the shock absorber that keeps the vehicle on the road when the macroeconomic terrain gets really rocky.
Okay, so after analyzing all this push and pull with the quarter's margins, the strong sales versus the heavy headwinds, let's shift our focus to what this actually means for the shareholders right now.
Yeah, the real-world impact.
Right, and what P&G expects for the rest of fiscal 2026. Because you literally cannot talk about Procter & Gamble without talking about their historic dividend.
You can't. It is a level of capital return that very, very few companies in the history of modern capitalism can even match.
It's truly staggering. I mean, P&G just announced its 70th consecutive year of dividend increases. Think about that for a second.
It's incredible.
7 decades of not just paying a dividend through recessions, dot-com bubbles, and global crises, but actively raising it. And it's their 136th consecutive year of paying a dividend overall, dating all the way back to 1890. This quarter alone, they generated $4.0 billion in operating cash flow. And they used that massive cash engine to return $3.2 billion directly to share owners. That's $2.5 billion in dividend payments and over $600 million in share repurchases.
Yeah, it just provides a massive floor of stability for their investors. When you hold a stock like that, you are basically getting paid to wait out the turbulent economic periods.
But looking forward, there is a very deliberate note of caution in their guidance. They maintained their all-in sales growth target for fiscal 2026, keeping it in the range of 1 to 5%.
Right.
They also maintained their core EPS growth target of in line to up 4%, which equates to roughly $6.83 to $7.09 per share. But they explicitly warned that they expect their EPS results to come in toward the lower end of that guidance range.
Yes, they did.
So what does this all mean? Why did management feel the need to temper expectations so publicly?
Well, it comes right back to those relentless macroeconomic anchors we discussed. The forecasting from management here is very specific, and it paints a pretty tough picture for the rest of the year.
How bad is it?
For the full fiscal year, P&G is expecting commodity costs to be a $150 million after-tax headwind. On top of that, they're estimating that higher international trade tariffs will cost them approximately $400 million after tax.
Wow.
And finally, they are expecting a net headwind of roughly $250 million from modestly higher interest expenses and taxes.
Okay, so when you bundle all those numbers together, tariffs and the rising costs of raw materials and borrowing are acting like an $800 million anchor dragging behind the company.
Precisely. And to translate that into shareholder terms, it equates to a massive 25-cent per share hit to their earnings for fiscal 2026.
That's a huge dent.
It is a very heavy burden to carry, and it is exactly why they're guiding toward the lower end of their range. They're telling Wall Street, hey, we are growing, but the friction is intense right now.
And this raises a really important question for me. How does a management team react when they are staring down the barrel of an $800 million penalty from things that are largely outside of their control?
Yeah, it's a test of leadership.
Right. Because the instinct, I imagine, especially for a publicly traded company under immense pressure to hit quarterly targets and please Wall Street, would be to just slash spending, to aggressively cut marketing, pause research and development, and just hoard cash to artificially inflate those shrinking margins.
What you just described is exactly the classic short-term corporate reaction. When margins get tight, the first thing most companies do is slash marketing.
Because it's easy to cut.
Right, because marketing is a variable cost that you can turn off tomorrow to immediately save next quarter's balance sheet. But that is absolutely not what P&G is doing here.
No.
No, if you look at the commentary from CEO Shailesh Jejurikar, he explicitly states that they are increasing investments.
Which feels entirely counterintuitive to me. If your margins are already getting crushed by tariffs, why would you actively choose to spend more money?
Because Jejurikar and the leadership team are operating on an integrated growth strategy. They know they're taking a hit on margins right now, but they're making a highly strategic calculation.
Okay.
They understand that if you cut marketing and innovation during a downturn, you might save a few pennies today, but you lose top-of-mind awareness with the consumer. And once you lose that consumer loyalty, buying it back later costs 10 times as much.
Oh, wow. So they are choosing to absorb the margin hits and spend the money anyway to widen their moat while their competitors are busy retreating.
Exactly. They are refusing to sacrifice long-term market share just to pad the current quarter's earnings report. They believe that by increasing spending on product innovation and consumer outreach right now, they will emerge from this difficult macroeconomic environment in a dramatically stronger position.
It's like an offensive move disguised as a defensive market.
That's a great way to put it.
It's a bold strategy, but I mean, when you have a 70-year streak of dividend increases and billions of dollars in internal productivity savings backing you up, you kind of have the financial shock absorbers required to play the long game. You can afford to endure the pain that might bankrupt a smaller competitor.
It is the ultimate luxury of scale, really.
All right, let's bring this all together. What are the absolute essentials you need to walk away with today? First, Procter & Gamble is demonstrating real underlying strength.
Yeah, absolutely.
That 2% organic volume growth proves people aren't just paying inflated prices, they are buying more actual physical units, especially in that premium beauty sector. Second, the company's cash flow remains an absolute fortress, allowing them to continue their historic streak of returning billions to shareholders through dividends and buybacks. But third, and probably most importantly for the broader economic picture, they're fighting a really heavy current. Global tariffs, raw commodity cost, and an unfavorable product mix are severely squeezing their profit margins, forcing them to rely on massive internal productivity savings just to keep their heads above water, and pushing their full-year guidance to the lower end of their estimates.
And, you know, the reason you should care about this tension, even if you don't own a single share of P&G stock, is because this company is a true bellwether for the global consumer.
Yeah.
Their products are embedded in millions of homes across 70 different countries. If P&G is seeing strong volume demand from everyday shoppers, but simultaneously facing severe multi-million-dollar margin pressures from international tariffs and supply chain costs, it gives you a perfectly clear, unvarnished window into exactly what is happening in the broader global economy.
It really is the macro and the micro colliding right there in the laundry aisle.
Perfectly said.
Which leaves us with a final thought to really mull over as we wrap up today's deep dive. We spent this time analyzing how P&G, this absolute titan of industry, armed with immense scale, billions of dollars in productivity savings, and an unmatched history of stability, is having to aggressively spend and maneuver just to offset the gravity of these global trade tariffs and margin pressures.
Yeah, they're working overtime.
So if a giant like P&G has to work this hard just to hold its ground against the macroeconomy, what does that mean for the smaller, emerging consumer brands, the ones that don't have a 70-year financial shock absorber to fall back on?
It's a tough environment for the little guys, that's for sure.
It really makes you wonder, can an emerging company innovate fast enough to forever outrun these kinds of macroeconomic headwinds? Or is massive scale really the only true defense? Definitely think about that next time you reach for the soap under the sink. Thank you so much for joining us on this deep dive, and as always, keep asking the big questions.